Have you ever felt your heart race faster than the market itself? One moment, you're on top of the world, convinced you've cracked the code to trading. The next, you're staring at a red screen, wondering how everything slipped away so quickly. If this sounds familiar, you're not alone. Trading isn't just about charts, indicators, or strategies. It's about managing the storm inside your head. Fear, greed, hope, and frustration are more powerful than any candlestick pattern. They drive impulsive clicks, sleepless nights, and blown-up accounts. This video is not another technical manual. It's your survival guide to the emotional battlefield of trading. You'll discover why your brain tricks you at the worst possible times, how to break free from destructive cycles, and what it really takes to stay calm, consistent, and profitable. Because in trading, mastering your emotions isn't just an advantage, it's the edge. Chapter 1. Fear at the Open. The opening bell rings, and in those first few minutes, the market feels like a wild animal, breaking free from its cage. Prices move fast, orders stack up, spreads widen, and volume surges. For new traders, it feels like standing at the edge of a roller coaster about to drop. Your palms sweat, your heart pounds, your finger hovers over the buy or sell button. You want to act, but you're not sure if it's the right move. That moment, the fear at the open, has ended more trading careers than bad strategies ever will. Fear at the open is not just a beginner's problem. Even traders with years of experience feel its pull. The open is unique because it compresses uncertainty, greed, opportunity, and risk into the fastest 30 minutes of the trading day. Prices can swing wildly, news can drop unexpectedly, and liquidity can vanish in seconds. If you don't know how to control your emotions here, you'll find yourself reacting instead of executing, chasing instead of waiting, and regretting instead of learning. But let's take a step back. Why does the open trigger so much fear? After all, it's just another part of the trading day. The answer lies in psychology. Humans are wired to fear uncertainty. The open is the most uncertain time of day because it's when the market resets and absorbs all the overnight news, global market moves, earnings releases, and investor reactions. Your brain interprets this chaos as danger, just like our ancestors did when they heard rustling in the bushes. Except now, instead of running from predators, you're running from red candles. Here's the trap. Your brain thinks it's protecting you, but in trading, those instincts often backfire. Fear tells you to hesitate on good entries, to exit trades too early, or to avoid trading altogether. It whispers that every green bar is about to reverse, and every red bar will crash further. It makes you see ghosts in the charts. I remember my first year trading. Every morning, I'd wake up hours before the bell, drink too much coffee, and stare at the pre-market data like it held the secrets of the universe. By the time the market opened, I was already on edge. One day, Tesla gapped up on news, and I convinced myself it was too high to buy. I froze, waiting for a pullback that never came. The stock ripped higher, and I watched in silence, paralyzed. The next day, a different stock gapped up, and this time I forced myself to jump in right at the open. Within minutes, it reversed, and I got stopped out at a painful loss. 2 days, 2 opposite decisions, both driven by fear. Fear doesn't just cost money. It chips away at your confidence. And when you lose confidence, you start second-guessing every decision, which only fuels more fear. This cycle can trap traders for months, even years, if they don't learn how to break it. So, how do you fight it? The first step is awareness. You need to recognize that fear at the open is normal. Every trader feels it at some level. The difference between amateurs and professionals is not the absence of fear, but how they respond to it. Professionals prepare. For the open, they have a plan, and they follow routines that anchor their minds. Amateurs wing it and hope for the best. Preparation is a powerful antidote to fear. Imagine a pilot taking off a plane. They don't just hit the throttle and hope the plane lifts. They go through a checklist. Instruments, flaps, fuel, weather. The open is the trader's takeoff, and you need your checklist. What's the broader market doing? Where are the overnight levels? What news just dropped? Which stocks are gapping up with volume? Having this prep work done before, the bell gives you a map. And when you have a map, the terrain feels less dangerous. But even with preparation, emotions creep in. That's where routines matter. Some traders meditate before the bell. Others journal their trading plan or even read affirmations. These might sound cheesy, but they work because they calm the nervous system. Fear is a physiological reaction. Your body releases adrenaline. Your heart races. Your vision narrows. If you don't calm that system down, you'll act impulsively. A few deep breaths, a minute of mindfulness, or writing down your top 2 setups can reduce that adrenaline spike and keep your thinking clear. Another strategy is reframing. Many traders see the open as a make-or-break moment. They think, if I miss the first 15 minutes, I've missed the whole day. That's simply not true. The market will be there tomorrow, next week, and next year. By reframing the open as just one part of the day, you reduce the pressure to act. Instead of thinking, I have to make money right now, shift to, I have to wait for my best setup, even if it comes later. Fear thrives under urgency. Remove the urgency, and you weaken the fear. Of course, fear also comes from risk. If you're trading with money you can't afford to lose, fear at the open will dominate you. The simplest fix: lower your position. Size? When the dollar amount at risk feels manageable, your brain quiets down. Most traders over-leverage, then wonder why they're scared. If a losing trade means you can't pay rent, no routine or checklist will save you. But if a losing trade means you lost the equivalent of dinner at a restaurant, you'll think more clearly. It's also useful to understand how fear manifests in behavior. Some traders freeze and miss opportunities. Others overtrade, thinking they can control fear by doing something. Both responses come from the same place: an inability to sit with discomfort. The skill to develop is sitting with that discomfort without reacting. Watch the first 5-10 minutes without trading. Let the market shake out. This builds patience and shows your brain that you don't need to react to every tick. Over time, the fear loses its power. There's another layer to fear: identity. Many traders tie their self-worth to their performance. If they make money, they feel smart. If they lose, they feel stupid. The open feels so intense because it feels like a test of identity. Am I a good trader or not? That's a dangerous mindset. You are not your P&L. You're a person learning a skill, and losses are part of the tuition. Detach your identity from the outcome, and fear loses one of its sharpest teeth. Science backs this up. Neuroscience studies show that when people face uncertainty, the amygdala, the brain's fear center, lights up. But when those same people are trained to reframe uncertainty as opportunity, activity shifts to the prefrontal cortex, the rational part of the brain. In other words, the stories you tell yourself change how your brain reacts. Tell yourself, the open is dangerous, and you'll panic. Tell yourself, the open is full of opportunities, and I'll wait for my setup, and you'll stay calm. Think about professional athletes. A basketball player at the free throw line in the last seconds of a game feels pressure too. Their heart races just like yours at the open. The difference? They've practiced thousands of free throws. They have rituals, and they trust their process. That's what you need to build as a trader, a process you trust so deeply that fear can't shake you. Practical tools help. Keep a trade journal, not just of your entries and exits, but of your emotions at the open. Write down, what did I feel? What was I thinking? Did I act on fear or follow my plan? Over time, patterns emerge. Maybe you always overtrade on Mondays or hesitate after a losing Friday. Once you see these patterns, you can prepare for them. Fear thrives in the dark. Journaling brings it into the light. Let's not sugarcoat it. Fear never disappears completely. Even after 2 decades of trading, I still feel a jolt at the open. The difference is, I know what it is and how to handle it. Instead of fighting fear, I use it as information. Fear tells me I'm about to risk something valuable. That's good. It means I respect the market. What I don't do anymore is let fear control my clicks. That's the line you need to draw. Fear can sit in the passenger seat, but it never gets to drive. The most liberating realization is that fear is a signal, not a stop sign. It's telling you to slow down, to check your plan, to measure twice before cutting once. Traders who listen to fear intelligently use it as a guide. Traders who listen blindly let it sabotage them. As you grow, you'll notice fear at the open becoming less about the market and more about yourself. It's not the charts that scare you. It's your own lack of trust in your preparation, your strategy, or your discipline. That's why mastering fear isn't just about trading. It spills into life. Learning to stay calm in the face of uncertainty makes you a better decision maker everywhere. Business, relationships, even health. So, the next time the bell rings and fear surges, pause for a second. Take a breath. Remind yourself, this is normal. I'm prepared. I have a plan. And I don't need to act immediately. Let the amateurs panic. Let the market show its hand. You'll be ready, calm, and patient. That's how professionals turn fear into fuel. Because in the end, trading isn't about eliminating fear. It's about mastering it. And once you do, the open transforms from a roller coaster drop into just another ride you've learned to enjoy. Chapter 2. The Greed Trap. Greed is the silent whisper that turns winners into losers. It's the voice that says, just hold a little longer when the smart move is to lock in profits. It's the thrill of thinking you're about to double your money if you stay in the trade just a few more minutes. And it's the crushing regret when the market suddenly turns against you and takes it all back. If fear is the emotion that keeps you from acting, greed is the one that keeps you from stopping. The irony of greed is that it doesn't always feel like greed in the moment. To the trader in the middle of it, it feels like optimism, like confidence, like riding momentum. You convince yourself you're being smart, that this time is different, that the stock will keep climbing because why wouldn't it? Only later, when the screen is red and the profit has vanished, do you realize it wasn't strategy? It was greed. Greed is so dangerous in trading because it disguises itself as opportunity. Fear at least feels uncomfortable. You know when you're scared. But greed feels good. It feels exciting. It makes you feel powerful, like you're about to beat the game. That's why so many traders fall into its trap. It's not the losers that wreck most accounts. It's the winners that could have been great but turned into disasters because the trader wanted more. I'll never forget one of my earliest encounters with greed. I was trading a biotech stock that had gapped up on FDA approval news. I entered early, caught a great move, and within an hour I was up several $1,000s. That was more than I had made in weeks. My plan said to take profit. But my brain said, this could go to the moon. Don't sell now. You'll regret it if you do. So I held, and held. At first, it went higher. My heart raced as my unrealized profit grew. Then, just as quickly, it turned, A wave of selling hit, profit-taking crushed the price, and before I could react, my green day had turned red. Not only did I give back my gains, I lost more than I had made. It wasn't bad strategy, it was pure greed. Psychologists describe greed as an extension of reward-seeking behavior. Our brains are wired to chase dopamine, the chemical of pleasure and reward. When a trade is working in our favor, dopamine surges. We feel good, confident, almost euphoric. Our brains trick us into believing that holding just a little longer will bring even more dopamine. But markets are not dopamine machines. They are unpredictable, and the second you start trading based on chemicals instead of strategy, you're gambling. This is why casinos are designed the way they are. Slot machines, flashing lights, the near-miss experience. It's all engineered to keep you in the chair just a little longer. Trading platforms with their green and red flashes, real-time P&L updates, and rapid price changes have a similar effect. They stimulate the same parts of the brain that gambling does. The greed trap is built into the very experience of watching your screen. The antidote is discipline. Discipline means having rules and following them, even when your emotions beg you to ignore them. This is easier said than done. When you're in a winning trade, everything in your body screams to hold on just a little longer. But this is where professionalism separates itself from amateur trading. Professionals know their exit before they even enter. They set targets. They define stop losses and profit-taking levels. And most importantly, they stick to them. One of the best tools against greed is scaling out. Instead of trying to nail the exact top, sell a portion of your position as it moves in your favor. This way, you lock in profit while still leaving some skin in the game. If the stock keeps running, you benefit. If it reverses, you've already booked gains. Scaling out is not just a strategy. It's a psychological hack. It quiets the greedy voice that says, "Don't sell yet," because you've already taken something off the table. Another powerful strategy is to journal your greedy moments. Write down the times when you held too long, what you were thinking, what you felt, and how it ended. Over time, you'll start to see the patterns. Maybe you always get greedy after 3 green trades in a row, or when a stock moves faster than usual. Awareness is the first step to breaking the pattern. Once you know when greed strikes, you can prepare for it. It's also helpful to reframe what a good trade means. Most traders think a good trade is one that makes the most money possible. That's not true. A good trade is one where you followed your plan, managed your risk, and executed with discipline. Sometimes that means you'll leave money on the table. That's okay. Leaving money on the table is not a mistake. It's the price of being consistent. Professionals know they'll never catch every penny. They don't need to. Consistency beats perfection every time. Greed also thrives when traders compare themselves to others. You see someone on Twitter post a screenshot of a massive gain, and suddenly your profit feels small. You feel like you're missing out, like you should have held longer, like you're not good enough. This comparison fuels greed because it shifts your focus from your plan to someone else's highlight reel. The truth is, you don't know their full story. Maybe they risked more than they should have. Maybe they gave it all back on the next trade. Comparing yourself to others is the fastest way to sabotage your own progress. Let's talk about the emotional aftermath of greed. When you give back profits, the pain is sharper than if you never had them in the first place. Losing $1,000 feels bad, but making $1,000 and then losing it feels 10 times worse. Psychologists call this loss aversion. We hate losing what we already have far more than we hate missing out on gains. This is why greed is such a trap. It sets you up not just for financial loss, but for emotional devastation. And once that devastation sets in, It often triggers revenge trading, which digs the hole deeper. The solution lies in setting realistic expectations. The market will always dangle the possibility of more. There will always be another trade that runs further than you expected. You can't catch them all. The goal is not to maximize every trade, but to maximize your longevity. If you survive, you'll have endless opportunities. If you blow up, you'll have none. Greed shortens careers. Discipline extends them. Think of trading like baseball. A great hitter doesn't swing for the fences every time. They focus on consistent contact, on getting on base, on playing the long game. Home runs come, but they can't be forced. In trading, consistency is your batting average. Greed is swinging at pitches you shouldn't, hoping for a home run. Eventually, it strikes you out. One of the most practical exercises against greed is to predefine both your entry and your exit before placing a trade. Write it down, not in your head, on paper, or in your trading software. Set your target and stop. Then, when the trade is live, follow the script. This removes the temptation to improvise in the heat of the moment. Improvisation is where greed sneaks in. Discipline is following the script you created with a clear head. Here's another truth. Sometimes greed is disguised as ambition. Traders tell themselves, "I'm just being ambitious, pushing for bigger wins." But ambition is about growth over time. Greed is about immediate gratification. Ambition is long-term. Greed is short-term. Learn to tell the difference. Ambition will build your career. Greed will end it. Some of the greatest traders in history have spoken openly about greed. Jesse Livermore, one of the most legendary speculators of all time, said it best. "It was never my thinking that made the big money for me. It was always my sitting." But even he lost fortunes multiple times because greed led him to overstay his welcome. If even legends can fall to greed, so can you. The difference is whether you learn from it or repeat it. When you think about it, greed is really about control. We want to control the market, to bend it to our will, to extract every last dollar. But the market cannot be controlled. The moment you try, you lose. The only thing you can control is yourself, your entries, your exits, your position size, and your mindset. The traders who thrive are not the ones who conquer the market. They are the ones who conquer themselves. So, the next time you feel that rush of excitement in a winning trade, pause. Ask yourself, am I following my plan, or am I being greedy? If the answer is greed, take action. Scale out. Take profit. Walk away. Protect your gains. You don't need to catch the top. You just need to stay in the game. Because in trading, greed doesn't just steal your money, it steals your future. Master it and you'll unlock the consistency that turns trading from a gamble into a profession. Chapter 3. Hope versus reality. Hope is one of the most dangerous emotions in trading because it feels positive. Fear and greed at least come with a warning. Your body knows when you're scared or overexcited. But hope feels comforting. It tells you things will get better, that the chart will turn, that you just need to wait it out. And that's why it destroys traders silently. When you're sitting on a losing position, the most natural instinct is to hope it comes back. You tell yourself, "It's only down a little. It'll bounce. The market's just shaking out weak hands. I'll sell when it gets back to break-even." Hours pass, days pass, sometimes even weeks. The loss gets bigger. Your conviction doesn't come from logic anymore. It comes from desperation. And soon enough, what started as a small, manageable loss turns into an account-destroying disaster. Every trader has been there. I've been there more times than I'd like to admit in my early years. I once held a stock that had dipped only a few percent below my entry. My stop was clear, but I convinced myself to ignore it. It's a good company. The fundamentals are strong. It'll come back. I even doubled down, buying more as it dropped. What I didn't realize was that the news behind the drop was far worse than I understood. Within weeks, the stock was down 40%. My account was wrecked, all because I hoped reality would bend to my wishes. Why do we do this? The answer lies in human psychology. Our brains are not wired for markets. We are wired for survival. When something we value is under threat, denial kicks in. Psychologists call it cognitive dissonance. We experience discomfort when reality clashes with our beliefs, so we change the story to make ourselves feel better. In trading, that story is hope. We tell ourselves lies to avoid the pain of admitting we were wrong. There's also loss aversion at play. Studies show that people hate losing money more than they enjoy winning it. Losing feels like pain. Our instinct is to avoid it at all costs, even if that means holding on to a sinking ship. Hope becomes the painkiller. It numbs the immediate hurt of taking a loss by offering the illusion that if we just wait, we won't have to lose at all. But here's the brutal truth. The market doesn't care about your hopes. The chart doesn't care about your entry price. The company doesn't care that you need the money back. Reality is indifferent. The longer you cling to hope, the more disconnected you become from reality. That's why traders say, hope is not a strategy. It's an emotional escape route that keeps you blind to what's actually happening. So, how do you replace hope? With reality? The first step is to respect your stop losses. Stops are not there to annoy you. They're there to protect you. They are reality checks. When price hits your stop, the market is telling you your thesis was wrong. Or at least, wrong for now. Professionals don't argue with stops. They honor them. Amateurs override them with hope. Cutting losses quickly is painful in the moment, but liberating in the long run. Imagine ripping off a bandage. It stings for a second, then it's over. Holding on to a losing trade out of hope is like leaving the bandage on a wound that's festering underneath. You might avoid the sting now, but the infection will only grow worse. Another key step is reframing losses. Most traders see a loss as failure, as proof that they're bad at trading. That's why they hope, because admitting the loss feels like admitting they're not good enough. But losses are not failures. They are data points. Every loss teaches you something about your system, your psychology, or the market environment. Professionals treat losses as tuition. They pay the cost, learn the lesson, and move on. Amateurs refuse to pay and instead pile up debt, emotional and financial. It helps to remember that every great trader has stories of catastrophic losses caused by hope. Jesse Livermore, Paul Tudor Jones, even modern hedge fund managers. They all warn against holding and hoping. If billion-dollar traders with decades of experience can't make hope work, what chance does a small retail trader have? The lesson is universal. Reality always wins. One of the biggest illusions hope creates is the dream of getting back to break-even. How many times have you said, "I'll just sell when it gets back to my entry"? That's not a strategy. That's an emotional crutch. The market doesn't owe you a return trip to your entry price. In fact, it often moves further away. The more you wait for break-even, the more you tie your self-worth to a price point that means nothing to the market. Reality says, cut it, reassess, and move forward. There's another angle here, sunk cost fallacy. This is the human tendency to stick with something just because you've already invested in it. If you put money, time, or energy into a trade, you feel like abandoning it would waste that investment. So you hold, hoping it turns around. But the truth is, the money is already gone. The past is gone. The only decision that matters is what to do now with the capital you still have. Sunk cost fallacy keeps you trapped in the past. Reality forces you to act in the present. I once coached a trader who had held onto a losing stock for months. He had invested heavily, watched it fall 30%, then 40%, then 50%. Every time it dropped, he said the same thing. "It can't go much lower. I'll just wait." By the time he finally sold, he had lost over 70% of his investment. If he had taken the original small loss, his account would have survived. But hope made him believe in a fantasy that never came true. So how do you build the discipline to face reality? Start by making peace with being wrong. No trader, not even the best, wins all the time. In fact, many professional traders win less than half their trades, yet they're profitable because they cut losses small and let winners run. Being wrong is not the enemy. Staying wrong is. You also need to develop a routine for reviewing trades. After every session, look at your losers and ask, did I hold this out of hope? Did I ignore my plan because I didn't want to admit I was wrong? By shining a light on those moments, you start to rewire your brain. The next time you feel that urge to hope, you'll remember the pain it caused before. Risk management is another tool that kills hope at the root. If you only risk 1 to 2% of your account on a trade, taking a loss isn't devastating. It's just part of the game. But if you over-leverage and put 20% of your account into one trade, of course you'll hope. You'll beg the market to save you because the loss is unbearable. The problem isn't just hope. It's the position size that makes hope feel necessary. Shrink your risk, and reality becomes easier to accept. There's also value in flipping the script. Instead of hoping your losers turn into winners, start hoping your losers stay small. That's a hope you can control. It shifts your mindset from, "I hope it comes back," to, "I hope I stick to my plan." That subtle change transforms hope from a fantasy into a tool for discipline. Over time, you'll learn that reality is a better ally than hope. Reality tells you the truth, even when it hurts. Hope tells you lies, even when they feel good. And in trading, truth keeps you alive. Traders who embrace reality build resilience. Traders who cling to hope eventually face ruin. The emotionals roller coaster of hope is brutal. At first, you feel denial, convincing yourself it's just a small dip. Then you feel bargaining, telling yourself you'll sell if it just comes back a little. Then you feel despair, watching it drop further. And finally, you feel regret, wondering why you didn't cut earlier. This cycle repeats until you break it. The way out is acceptance. Accepting that you can't control the market, but you can control your decisions. When you cut a loser quickly, you might feel pain in the moment, but you gain freedom. You free your capital for the next opportunity. You free your mind from the constant stress of watching a sinking position. And most importantly, you free yourself from the emotional prison of hope. That freedom is priceless. So, the next time you're tempted to hold and hope, stop and ask yourself, am I seeing the market as it is or as I want it to be? If the answer is the latter, it's time to face reality. Close the trade. Take the lesson. Move on. Because in trading, hope might feel comforting, but reality is the only thing that pays.